Zhejiang Financial Asset Exchange Center has collapsed. 20 billion yuan in funds have evaporated, and tens of thousands of investors have lost everything. A platform wrapped in the halo of state-owned capital, openly raising money under the nose of regulators, has finally imploded. Behind it lies not only the financial black hole of the private conglomerate Xiangyuan Group, but also a tragic reflection of the fate of China's private enterprises. Don't miss the next drop, subscribe and hit the bell. Today, we will break down this chain reaction collapse, from finance to real estate, from state-owned capital to private business, an unfolding tragedy of state-owned banners, private companies taking the blame, elites profiteering, and ordinary people suffering. Zhejiang Financial Asset Exchange Center, Zhejin Center, has officially blown up. The amount involved exceeds 20 billion yuan, affecting more than 10,000 ordinary investors. What deserves special attention is this: Zhejin Center always presented itself as having a state-owned background, earning the trust of investors. But before the collapse, state capital quietly withdrew, the platform's qualifications were revoked, and yet nothing was disclosed, allowing it to continue absorbing funds from the public. Founded in 2013, Zhejin Center once enjoyed approval from the Zhejiang Provincial Government Office, as well as backing from the Finance Department and other state-owned entities. It was packaged as a safe investment product, almost like a quasi-government bond. Its advertising was bold: government-guided, market-operated, state-owned platform, safe and reliable, phrases that sounded like sleeping pills for investors. But starting last October, the Zhejiang Provincial Financial Administration revoked the platform's operating qualifications. Then in January of this year, 58% of its equity was sold to a private company. The so-called state-owned platform had already been transformed into a private firm. Yet its website and WeChat accounts remained unchanged, leaving investors to mistakenly believe it was still state-backed. Starting in late November, Zhejin Center suddenly stopped repaying maturing investments, transaction records disappeared, withdrawals froze across the board. Investors panicked. Many flocked to Shaoxing to demand an explanation, and online groups formed rapidly as people tried to organize. Investment amounts ranged from hundreds of thousands to several million yuan. Investors with 5 million yuan or more were not uncommon. The total amount involved has reached 20 billion yuan, with more than 10,000 victims, a shocking number. Even worse, after the blow-up, elderly victims knelt in despair outside government buildings, weeping and begging for their life savings. Instead of solutions or repayments, many were met with arrests and detention by special police. On December 5, Ding Jianlin, chairman of Zhejin Center, and Shen Baoshan, CEO of Xiangyuan Group, personally came out to calm emotions. What they said instantly chilled investors: "We are no longer capable of repayment. We hope the Shaoxing government will inject capital and act as a white knight savior for the company." All financial products connected to the Xiangyuan series, under Zhejin Center, have defaulted. This scam relied on the illusion of state-owned background and AA+ ratings to deceive investors, while in reality Xiangyuan Group used the money for its own financing, bearing all the risks itself, ultimately filling the financial black hole created by its failing real estate ventures. In essence, this financial explosion is the classic tragedy produced by China's political economic system: state-owned banners, private companies taking the fall, elites carving up profits, and the people paying the price. Tracing the roots, the real source of the explosion is Xiangyuan Holdings. The company's fate has always been tied to the trajectory of its founder, Yu Faxiang, a Zhejiang businessman once celebrated as a success story of rags to riches. Born in 1971 in a small village in Shenzhou, Zhejiang, Yu came from a poor family and dropped out of school at age 15 to work. He apprenticed at a brewery, later moved to Ningbo and Shanghai, selling fruit, tea, and sweaters. Through these small businesses, he earned his first pot of gold. In 1992, as the CCP pushed reform and opening to ease a governance crisis, a wave of entrepreneurship swept across China. Yu immediately sensed opportunity and went to Hainan, founding Weixiang Decoration Company, the predecessor of Xiangyuan Group. But soon after, the 1995 Hainan real estate bubble burst, leaving countless developers bankrupt. Yu instead used the crisis to refine his business philosophy. He founded Hainan Xiangyuan Industrial and completed a pivot from interior decoration to real estate. Then came 2001, a turning point. Yu entered the capital markets for the first time, acquiring control of the listed company Cheonghae for 1.6 billion yuan. The move made him famous and laid the foundation for future expansion. By August that year, he formed Hainan Xiangyuan Industrial Company, and around this time partnered with Shen Baoshan. They began developing various real estate projects across Haikao, Shenzhen, Shaoxing, and Shenzhou. Soon, the company's real estate focus shifted to Anhui. Xiangyuan's official website shows significant projects starting in 2002, including major redevelopment efforts and commercial complexes. The true turning point came in 2008. You aggressively expanded into the cultural tourism industry and proposed a unique business model: use real estate profits to support cultural tourism. Property sales generated cash flow to sustain long-cycle, slow-return tourism projects, which in turn enhanced land value. At first, it worked brilliantly. Over the next decade, he acquired scenic destinations from Fenghuang Ancient Town to Yellow Dragon Cave in Zhangjiajie and Qian Mountain. More than 20 well-known tourist attractions became part of the Xiangyuan Empire. The company also gained control of two publicly listed firms, Xiangyuan Culture and Tourism and Zhejin Group. In June this year, Xiangyuan bought Hong Kong's Haichang Ocean Park for 2.295 billion Hong Kong dollars, with the deal closing in October. By then, Xiangyuan controlled 3 listed companies and had been on the China Top 20 Tourism Groups list for 7 consecutive years. The empire kept expanding. Yufaxiang reached his peak. Xiangyuan's assets reached 60 billion yuan, he was honored as a Zhejiang Outstanding Private Entrepreneur, and in 2019 he entered the Huruan Rich list with 11 billion yuan. By 2025, though the ranking shifted, his wealth had risen to 14.5 billion yuan, making him Shenzhou's richest man. But after 2019, Xiangyuan's real estate investments surged. They bought 4 parcels of land in Ningbo, invested heavily in Shanghai, and expanded into Suzhou and Hangzhou. The crown jewel was Shanghai West Kong Road 989, a luxury development that sold 4.5 billion yuan worth of units in 2020, putting you in the spotlight once again. But the boom didn't last. After 2021, Xiangyuan went nearly silent. And its last significant land purchase was in 2022, after that, nothing. Insiders put it bluntly. Xiangyuan's foundation is in Anhui. Outside projects were scattered. They depended on tourism to drive real estate and real estate to subsidize tourism. But after 3 years of COVID and collapsed tourism revenue, the model no longer worked. Tourism projects stalled, cash flow dried up, and what used to generate profits became financial burdens. Meanwhile, Xiangyuan's 3 core businesses, real estate, tourism, and infrastructure, relied heavily on real estate. But real estate never went public, meaning it had to carry the financial weight of the entire group. As China's real estate market entered a deep freeze, this reverse subsidy system collapsed. Sales fell sharply, from 5 billion yuan to 3.5 billion. Settlement revenue dropped from 5.8 billion to 4.1 billion. This year's sales were abysmal, only 1.15 billion in the first half. The numbers tell the story: the harder they tried, the worse it got. While many assumed Xiangyuan was just struggling temporarily, the real crisis was already growing: stalled projects, unpaid debts, and a financial chain stretched to breaking point. One would think you could rely on listed companies for liquidity. But he had long pledged most of his shares. Xiangyuan Culture and Tourism had a staggering 96% pledge ratio. Zhejin Group's top 4 related shareholders had pledged 83% of shares. Such levels are dangerous. A small drop in stock price could trigger forced liquidation, wiping out assets instantly. Analysts point out that Shen Baoshan's claim that assets can cover liabilities is unrealistic. Shares pledged out can't be freely sold, many receivables cannot be collected, real estate assets are illiquid in a declining market, and Xiangyuan still holds many unfinished projects. Selling properties to raise cash in today's market? Nearly impossible. Thus, the claim "assets cover liabilities" is nothing more than numbers on paper. In reality, the company lacks usable cash, and that is Xiangyuan's most fatal crisis. Meanwhile, the Zhejin Center products backed by Xiangyuan offered yields above 5%, while Xiangyuan admitted their financing costs were 8 to 9%. In today's sluggish economy, This was like licking blood from a knife's edge, unsustainably risky. As the property sector collapsed, projects stalled, funds froze, and even the principal disappeared. Now, Xiang Yuan is negotiating with the government, hoping authorities will bail them out. Whether the 20 billion yuan disaster can be resolved, and whether the government is willing to take over, remains uncertain, especially in an era where even governments face financial strain. Will Xiang Yuan sink completely, or will it be rescued? The recent shift in the government's stance toward Vanke may offer clues. Prominent Chinese lawyer Wu Lei, who has defended private entrepreneurs for years, has witnessed countless tragedies involving business owners. Many people believe Chinese entrepreneurs get rich through collusion with officials. But a significant number of them are educated, idealistic, principled individuals who began with nothing and built businesses through hard work, often giving back to their communities, like Sun Dou. Yet their fate often ends not in success but in absurd tragedy. Years ago in Shaoxing, an entrepreneur and his entire family were labeled a criminal gang. Only one family member remained free. Desperate, he scraped together 300,000 yuan to hire Wu Lei's legal team. Local police threatened him. If you want your family to receive lighter sentences, fire all your lawyers immediately. He had no choice. But after firing them, the police did not honor their promise. They arrested even more family members. In utter despair, he climbed to the 7th floor of the Public Security Bureau and jumped. His final words were, "I truly have no money left." Such tragedies are not isolated. In China's business environment, private entrepreneurs have never been allowed to survive normally. Their survival does not depend on the market, it depends on political power. If you don't dance with the system, you can't survive. But if you cater to the system, eventually the system will devour you. This is the evil of the system, the evil of the CCP, and whoever gets close to it will be swallowed. This is not the fault of private entrepreneurs, it is the curse of the system itself. Remember the Prince Milk case? It became the most iconic example of how the Chinese government destroyed a thriving private enterprise in less than a year. It became a textbook example of the original sin of private businesses and the tragedy of state takes over, private retreats. When an entrepreneur falls, it is a warning sign for an entire era.